There's a third way that you can access the equity in your home that up until about 3, 4 days ago, I was not aware of. And I imagine if I wasn't aware of it, most of you probably weren't either. So stay tuned here. We're going to dive into this, and I'm going to run some spreadsheet numbers to show you how this can work. I'm actually pretty intrigued by this, and I think it's interesting. So I was watching a video by my man Beat the Bush, and he talked about this thing called Unison. He got a flyer on how to access your equity without making any payments with no interest rate. And he said it sounds too good to be true. Now, I don't know the guy Beat the Bush's first name, but he was kind of down on it. He read the fine print. He was down on it. And I had never heard of this Unison thing, or even what's called shared. I forgot what they call it, but the lender is partaking in your appreciated value. So they're kind of sharing in the equity, if that makes sense. I looked at some other financial planners, and they weren't big on it either. And I said, I wonder if they're missing the boat here. So I decided to run my own spreadsheets on this, as I do, just to kind of get it in my head and see what the pros and cons are. So remember, there's two ways typically to access your equity in your home. One is you take a reverse mortgage. If you're over 62 years old, you take a reverse mortgage and you don't pay anything back. You can, but you're not obligated to pay anything back. The drawback about the reverse mortgage, frankly, is the closing costs are pretty high. And part of the closing costs, a significant amount, is the insurance that you're paying to the federal government because it is a non-recourse loan, which means you will never owe more than what the appraised value is of your home, which is good. So basically, you know for a fact that you'll never be upside down. Now, the reason they do that is because there's an insurance. Basically, it's FHA saying we will guarantee that the borrower, the person taking the reverse mortgage, never is upside down. To do that, though, the borrower is paying a pretty hefty insurance premium, almost like a PMI. And that inherently only makes sense because the federal government's on the hook. Why should the taxpayer be on the hook for your value of your home being upside down when we didn't get any value of that at all? So we shouldn't be on the hook for that. So that's what the federal government's doing, is we're going to put this insurance program in place, funded by you, the borrower, in which to make sure we can be good on the obligation that the federal government has in case your home does go upside down. So I got no problem with that, but it is expensive. No getting around that. I think it's like 2.5% of not of the loan amount, but the entirety of the home value. So it's pretty hefty for sure. But again, that's the cost of doing business. Number two is a home equity line of credit or home equity loan. And again, a lot of Dave Ramsey, Susie Orman's, a lot of financial planners are negative on reverse mortgages. So they say the alternative is HELOCs, and it boggles the mind. I mean, if you have $100,000 value of your home and you're trying to tap in, 50% loan to value, the mortgage, they're going to underwrite you. So that's $50,000. So you have $100,000. They're going to try to tap in $50,000 of home equity line of credit. The bank's going to say that's great. You're going to have your minimum monthly payment will be probably 1% of that amount that's out, not the line of credit that's outstanding, the line amount, not the borrowed amount, but the actual line amount. So they're going to say your minimum monthly payment on $50,000 times 0.01 is going to be $500 a month. And you're like, well, I only want to borrow $10,000. So they're going to say, no, it doesn't matter. We have to assume you're going to borrow the entirety of the loan. So we're going to underwrite you as if you have a minimum monthly payment of $500 a month. And that's at 1%. A few years back is 1.5%. You had to qualify for your minimum monthly payment. And that goes to your debt to income ratio. So if all you have is Social Security at $30,000 a year and you have a line of credit available to you at $50,000 with a minimum monthly payment of $500 a month, even if you don't borrow it, that means you got $6,000 a year divided by $30,000 of Social Security. That's 20% right there, debt to income. And so if you have other debt, it's just not going to happen. I'm just telling you, it's not going to happen. The idea that home equity lines of credit are just there for everybody to take when they're retired and not make any money is just silly. It's just silly, and it drives me crazy. All right, so this one here is Unison. So what they do is they're going to, and here's, I show you the PDF. Let me get there real quick. And here's a PDF on it. I like it, actually. Oops. I like it to some degree. Let's see if I can't make that bigger. Oh, yeah, sweet. There we go. All right, so what they're saying, this is going to be a lot to chomp on. Let me just explain it to you. It'll be easier if I just explain it. So what they're doing here is they're saying, we are going to loan you a percentage of your available equity of your home value, and if you have equity in it. So In this case, they're going to say we're going to loan you 10% of your home value. Let's just say you have nothing outstanding, 10%. So your home value is $500,000. They will loan you $50,000. No interest, no payment, nothing. You don't owe anything. You don't pay anything back until you sell your home. Now, it is a loan. It's just you don't make any payments. You don't make any interest payments. You just pay it back when you sell the home. I hope that makes sense. So it is a loan, but you're just not making monthly payments and you're not being charged interest. Instead of the interest charge, what they're doing is they're saying, we will take a portion of the appreciation of the entirety of the home value. Now, I'm going to show you how this works here in just a second. So it's not an interest payment, but it's certainly potentially an interest payment because you're paying more than what you borrowed. I mean, they can call it interest. They can call it coffee cup. They can call it whatever they want. Semantics, it's still you're paying more back. But the nice thing is you don't have to pay it back while you're using the money. You only have to pay it back once you sell the home, which I think is pretty sweet. Because if cash flow is an issue for you, we just got to get you to survive today. And this is where I think a lot of financial planners make the mistake of saying, oh, this, we compare apples and apples. I'm getting 6%, you're getting 5%, 6% is better. So you should do the 6%. Well, if I'm hurting for cash flow, man, and I just got to get by retirement. If the only thing I have at my disposal is a house equity that I have, screw your freaking 6%. I just need to have access to it because I don't want to move. I like my neighborhood. The cost of moving is expensive. Lots of people move to a different neighborhood and they're miserable because they miss their neighbors. They miss the day-to-day activities that they've been accustomed to. And a lot of people don't want to do that. In fact, I'm just telling you, I've done videos on the net migration patterns of retirees, and just not many people move. I'm just sorry, they don't. So a lot of people want to age in place. So they say, I got all this equity. How do I access to it? And again, home equity line of credit, reverse mortgage, or in this case, they call it like shared equity or something like that. And I like it. I think I was a big fan of it. So let's dive into an example here. And I'll put the links in the show notes here. But this example I did. Now, in this case, I said, okay, because I always got a spreadsheet. So I'm reading these financial planners negative on it. And I think the financial planners, the problem is we're so accustomed to what will it be worth in the future relative to the need I have today. And that... And the ration, that's just not, that might seem rational from a pure mathematic perspective, but in reality, people are just trying to get by today and they need cash today to get by. So if I say, oh, you're going to be out, I don't know, $25,000 of an opportunity cost because you did X, you shouldn't do that. And you're like, that's great, but I need to get by today. I think we focus too much on the spreadsheet's numbers and we say, okay, the spreadsheet says do this, don't do that. And then we don't focus on the reality at hand, which is people living their day-to-day lives. In fact, just a perfect example of this, financial planners will say it doesn't make sense to pay off your mortgage. And they'll say, you have a $200,000 inheritance and you got a $200,000 debt, and we'll just say the $200,000 debt costs you 3.5%. They'll say, no, don't pay that off. You should invest that money because historically we can beat the rate of return that's costing you at the bank at 3.5%. They'll say we can get 7%. But the problem is there's lots of problem. The fluctuation, obviously, of the interest rate. And so, so you just don't know. And we were taking a gamble that we could get 7% for a fact that we are paying 3.5%. We know that for a fact. So we're gambling the future based on past potential with a fact that we know for a fact we're paying 3.5%. That's not, I don't like that. And then secondly, I say, well, if the spreadsheet model works so well, why don't we just all have 100% loan to value, borrow every single penny against our home at all times? Why would we ever pay it off? We have a $100,000 house, borrow $100,000 at 4.5% and put in the markets. No one would advocate that because they know it doesn't make sense. Just because the spreadsheet model shows it could make sense, it doesn't. And that's where I think a lot of financial planners miss the boat. I think they're too focused on spreadsheeting the analysis of it from a pure X equals Y thing as opposed to the reality on the hand, which is people are inherently irrational beings. But for them, they're acting rationally. They're acting rationally that they need cash today, regardless of what your stupid spreadsheet shows. So, all right, let's go to the example. So in this case, we've got a $500,000 home value. We're going to say it appreciates at 3% a year. All right, we're going to do this for 20 years. Oops. Okay, keep going. Yeah, 20 years. We're going to do it for 20 years. All right, then you're going to die. 3%. So the appreciation amount is $15,000 in the first year. So $500,000 appreciates at 3%. Got $15,000 appreciation in the first year. The end of year home value is $515,000. With me so far? So don't pay anything over here for the time being. So if we do this for 20 years, it appreciates at 3% each and every year. We'll have $876,000 at the beginning of year 20, and at the end of year 20, our value of that home will be $903,000. Hope that makes sense. So $500,000 today appreciates at 3% for 20 years. It'll be worth $903,000 in 20 years. All right, follow me there. All right, now what happens with the Unison example, and there are some other firms that do this too, is that they'll loan you $50,000. In this example, we're using a 10% loan. All right, we're saying we are going to loan you $50,000 to basically, you can do whatever you want with. You can sniff it up your nose if you want. We're going to loan you $50,000. Now, what happens is to loan you 10% of the home value. Now, again, I'm just assuming you have no debt. To loan you 10% of the home value, they're going to take a 40% stake in the future appreciation of the entirety of the home, not just the loan that they made to you. So they're saying, look, if your home appreciates by 3%, we're going to take 40% of that appreciation. I hope that makes sense. So in this case, we're borrowing $50,000, all right, on $500,000. They're going to take 40% of any appreciation that they're going to get. So let's say you sell your home after year 3, because there is a 3-year minimum. You're going to pay back what you borrowed, $50,000 plus 40% of the appreciation amount, which in this case is $18,545. And how do we figure that out? Because $500,000 at 3% a year, compounding, appreciates to $546,000 at the end of 3 years. So that's $46,000 of appreciation. They're going to get 40% of that. So $46,000, we take 46 times 46 times 0.4, and they're going to get $18,545 of that total appreciation of $46,000. Hope that makes sense. So now I got to take the $18,545 and add it to the amount I borrowed, which is $50,000, and I paid them $68,000 back. That makes sense? Now, don't forget, I borrowed $50,000 from my home. And so after the borrowing and after the money I got paid back, so the end of the year value of my home is $546,000. All right, so I have $500,000. It appreciates at 3% a year. After 3 years, is worth $546,000. I got to pay Unison back $18,545, the 40% of the appreciated value over that time, plus the $50,000 I borrowed from them. So I got to pay them back total of $68,545. My house sells for $546,000. So at the end of the 3-year time, I get back $477,000. Now, again, I have that $50,000. I've done something with it. I mean, again, I could literally do anything with it. But I got $477,000 at the end of the 3-year time. I know that's a lot to chomp on, and I'll probably do another video on this to re-explain it because I think it's quite important. So you're saying I borrowed $50,000. Unison gets $68,545 back. I get at the end of the sale, after I sold the house after 3 years, I get $477,000, but I still have the $50,000 I had that they gave to me. So for me, it's actually I'm making $477,000 plus $50,000. So I'm actually truly getting back $527,000 again, depending on what I do with that $50,000 bucks. All right, so let's just keep playing this. We're going to go to year 20. At the end of the year 20, a 3% appreciation, my house is worth $903,000. All right, so I had my house, I mean, literally, it went 3% a year. So I borrowed, so I had $500,000 to start with. It's now worth $903,000. Unison takes 40% of that gain, that growth of 500 to 903, which is $403,000 that the total appreciation is. They take 40% of that. So we take 403,000 times by 0.4, and we get 161,000. So Unison gets 161,000, 40% of the appreciated value of the entirety of the home. Plus they get the 50,000 I put back, I borrowed from it to begin with. All right, so now when I sell the house for $903,000, assuming again I don't have a mortgage, the first thing I do is I got to pay Unison a check for $211,000, which means my net proceeds is $691. I hope that makes sense. So at the end of 20 years, I will get $691. Unison will get $211. Now I still had that $50,000 that I did something with. I could do whatever I want, but that's how it works for Unison. Unison is saying, look, we're going to give you the money. We're not going to expect any money back until you sell. And for them, the reason that's pretty attractive because they're saying we're getting a pretty good bang for our buck. And I figured it out. So if we say Unison, they start with $50,000 is our present value, and we end with $211,000 is our future value, and we did it for 20 years, and we had no payment. That is a 7.46% rate of return. So for Unison, that's pretty good. They're like, man, we got 7.46% year over year rate of return on the money we granted you. Now, we don't get anything for 20 years, and that's the benefit of just a long-term investment. The longer you can hold it on, the better off you are. Now, what does that tell you, 7.46%? Well, if you were to take this $50,000 and invest it, you would need to get 7.46% to break even. And so what I want to show you here is I take $50,000, all right, and let's say I don't spend it. I just say, I'm going to get the equity out of my house because I think I can do better in the markets. And I invested at 7.5%. My $50,000 after 20 years is worth $212, $212,000, which is exactly what I owe Unison. So if I got 7.5% on my money that I borrowed from Unison, I would have exactly enough to pay them back, and I would be broken even. If I got less than 7.5%, so we'll say we get 6%, 06, all right. I'm going to share with you a couple of things. Then I'll get, if I got less than, here I will be on the hook for $50,000 because of $50,000. So that's what I owe Unison, $211. That's what I have for my $50,000. I've been growing at 6% compounding. I just pay them back what I got to begin with, $50,000. And when you factor inflation, that's gonna be like a freaking dollar today. And so that's the interesting thing. So now if I got 10%, and I wouldn't expect you to, but let's just say 10% just to make it fun. Then I would have borrowed Unison's money, all right, and I would have done much better over time. I would owe Unison back $211. I would have $336,000 from their money. So in this case, Unison is taking the risk that they are my home is gonna appreciate more than the value that they could give if they were to invest it. Now, why would they do this? Because no one A thinks they're going to get 10% a year in the markets. No one thinks that. B, but these are pension funds, insurance companies, endowments. These are companies that want a more stable rate of return backed by solid assets. And solid assets are a piece of real estate, man. There's no other way around it. And they look at your credit rating to make sure that you're not going to get foreclosed on. So they look at your credit rating. So they're saying, we are betting that you have a nice house, a good credit rating, and we think a nice house could be anything you want. It's very subjective. But if you have a good credit rating and good equity, Unison thinks there's a reasonable assurance that they're going to get paid back, and they're going to get paid back with a pretty good rate of return potentially too. And again, here is 7.49% after 20 years. That's not too bad, man. All right, so that's how it works. So if you were to borrow, again, $50,000 and invested at 10% a year, then you would have made money from Unison. Unison's happy. They got 7.49. You're happy you made more money. But what if you don't invest it at all? Because this is the whole point. What if you just use it for cash flow? Use it for, to redo your home to get wheelchair access. What if you do all that? Yeah, it's going to cost you. 20 years from now, it's going to cost you $211,000, of which $161,000 is the appreciation. I hate to say it, but who cares? Literally, who cares? You'll be 85 years old at that point. Or you'll be dead and your kids will inherit it. This is where the financial planners make the mistake. They just look at it as tit for tat. And I said, no. for you to have access to your cash in your equity of your home without having a monthly payment in order to live comfortably, even if it costs you essentially 7.49% of the appreciation value, just who cares? I'm not. You're going to live comfortably in the place you want to live with no more cash flow outflow. I don't get why that's such a losing situation. It's not a comparison of apples to apples. It's a comparison of your own emotional stake, where you want to age in place, and the fact that you can use this to do something that you might not otherwise have been able to do, or just pay off credit cards, or just pay off your home equity line of credit to reduce your cash outflow so you don't have to sweat and worry so much. You're still going to get equity. The facts are you're still getting 60% of the growth of the equity. It's not like you're not getting anything. So here, yes, you only got, you're losing $161,000 of that equity. So you made, in this case, we borrowed $500,000. We had $500,000 to start with. It grew at $403,000 of equity, of which Unison gets $161,000. We're still up $242,000 of equity. So it's not like we lost money. We didn't. We just didn't make as much if we would not have done it. Yeah, stinks, but guess what? You have $50,000 that you could have done so many other things with today. This is a future. I don't care about the future. I care about now. Now, should you go this and go splurging? No. Obviously, you want to, maybe you want to put a pool in your home. I mean, I literally don't know idea. Maybe you want to just do something to enjoy it. Like I said, screen your back porch, do some wheelchair access, maybe pay off some debt, help your kid to college, whatever it is. Maybe there's something that you want to do that you're cash strapped, you can't. Maybe you just want money in a checking account so you don't have to draw so much on your 401k while you're hanging in there until Social Security kicks in. I mean, all kinds of different things. Now, the interesting thing is, if you do this, and I'll actually do this, I think it'll be interesting to do this in regard to delaying Social Security and delaying pulling off your 401k too, because remember, this is tax-free. I'll have to do an episode on that because I think that'll be interesting. So I like it. I'm a fan. I did a pre-qualified, so initially I was pre-qualified on my home value because, again, they're going to look at your credit rating and they're going to look at your home value and they're going to say, hey, do you qualify? I like it for actually. So let's just say you got $25,000 of credit card debt at 10.99%. And you're like, man, this payment is killing me alive. Well, do a Unison thing. Take the $25,000, pay off the credit card. 5 years from now, you sell your house. Yes, Unison will get a portion of that. In 5 years, they'll get, in this case, $31,000 on $50,000. All right, well, what to do? But you don't have the credit card debt, and you don't have to just the chaos in your mind of knowing you have to pay these credit card high fees. So, all right, stay tuned. I'm going to do more on this. I'm a fan. I'm trying to get one of these guys on a podcast to interview him because I think this would be pretty cool. So we shall see. So let me know what your thoughts. I would love to hear it. Have you done anything? Have you heard of these guys? Any experience? I'd love to hear your thoughts. So stay tuned, and we'll see you next time. Thanks.